All right. Okay. Thanks everyone for joining me today. We have a pretty good turnout here. So today we're going to do something a little bit different. I'm going to walk you through one of the core main tools on the Validea research site. It's called our Guru Analysis Engine, and I'm going to demonstrate what goes into that tool and how both retail investors and professional investors utilize the tool. But before I start with that, I do think it's important to sort of just walk you through some of the important ways and reasons that the Guru Analysis tool was basically developed and how these strategies were identified. So the first thing that we want to get at today is on Validea, we track and follow over 20 different investment strategies based on legendary investors and other time-tested investment strategies. So for us, what we look for, what is very important when we're capturing and codifying and implementing and offering a strategy on Validea is it has to really have three things behind it. First, it has to have a real world, long-term track record of market outperformance. And that's either in the real world from like the gurus we follow, or in the case of some of the academic strategies and other strategies that are in books, it has to have a long-term backtest behind it. Second is the strategy needs to be publicly disclosed. So it needs to be offered or outlined in academic papers or books or other sources. So it has to be in the public domain. And then three, the strategy has to be largely fundamental. And that means it can be captured and run quantitatively via computer programming and modeling. So those are the three things that we look for when capturing a strategy and offering it on Validea. Just in terms of a general disclaimer here, none of the individuals mentioned in today's presentation endorse any of the strategies or our implementation of the strategies. Our models are extracted from publicly available sources, and they're not meant to represent the gurus or the individuals themselves. All of the strategies are quantitative in nature, and the gurus themselves may have changed, altered, or never followed these exact strategies. The information presented is intended to give you an understanding of the active and quantitative stock selection strategies only. In addition, individual stock selection can be very risky, and none of the material discussed in this presentation should be construed as investment advice or as an individual stock recommendation. So, who are the strategies and gurus that we follow on Validea? Let me walk you through most of them, and I'll use this slide to do it. And so I'm going to kind of go a little bit fast through this, but I think this does a nice job of sort of showcasing all the different models and strategies, who those models are based on, and then the sources as well. So starting from left to right and top to bottom, the first model we run is based on Peter Lynch's growth at a reasonable price investing approach. It's the strategy he outlined in his book, One Up on Wall Street. As many people know, Lynch was perhaps one of the greatest fund managers of all time, running the Validea Magellan Fund. I think over a 13-year period, he generated about a 29% annualized return. We run a contrarian-like investment strategy based on David Dremen's value model that he outlined in his book, Contrarian Investment Strategies. We run a strategy based on John Neff's approach, which he outlined in John Neff on Investing. From 1964 to 1995, John Neff guided the Windsor Fund to a 13.7% annualized return, beating the market by about 3% a year. We have a value model based on Ken Fisher's super stock strategy. In this model, he outlined and popularized the price to sales ratio. I skipped Benjamin Graham, who's above that, which I didn't mean to, but we have our Graham strategy based on the deep value approach that he outlined in his timeless book, The Intelligent Investor. There's the magic formula, which was written about and developed by Joel Greenblatt in his book, The Little Book That Beats the Market. This is a combination of Graham's value approach and sort of Buffett's high quality approach, and it combines those two concepts together in a relatively simple and straightforward quantitative strategy that he called the magic formula. We run a strategy based on William O'Neill's book, How to Make Money in Stocks. There's a model based on Warren Buffett, of course. There's a lot of books based on Buffett's investing approach, but the one that we found that offers a quantitative method for emulating Buffett is the book Buffettology. We'll look at that Buffett strategy today in a little bit more detail. There's a growth investing model based on Martin Zweig's Winning on Wall Street. At one point, Zweig had the top rated risk-adjusted performance as tracked by the Holbert Newsletter Digest. So he had a very successful newsletter with a very good track record behind it. We have a model based on the research done by Meb Faber. And from his book, Shareholder Yield. Shareholder Yield captures all the ways a company can return cash to shareholders. We have multiple strategies based on the work and the backtesting of James O'Shaughnessy from his book, What Works on Wall Street. What Works on Wall Street, as some investors know, was really a seminal book in terms of systematic and simple quantitative investment strategies and the ones that have worked best over time. We have a model based on the Motley Fool Investment Guide, written about by Tom and David Gardner. It's really a small cap growth investing strategy. We run a strategy based on Tobias Carlyle's value approach that he outlined in The Acquirer's Multiple. That strategy looks to identify companies and tries to get at what a private buyer might pay for them, and then looks for the most attractive based on that type of valuation methodology. Wayne Thorpe, he's an analyst at AAII, and he wrote a paper on earnings revisions. The name of that paper is How to Profit from Earnings Revisions and Analysts' Earnings Estimates. So we run an earnings revision model based on his work. There's a growth investing strategy built from Partha Mohanram's research and his academic paper, separating winners from losers among low book to market stocks using financial statement analysis. There's another value model based on Joseph Piotrowski's work. Piotrowski's an academic. He's a professor at Stanford now. He was at Columbia when he wrote the paper, Value Investing, the Use of Historical Financial Statement Information to Separate Winners from Losers. We run a strategy based on Patrick O'Shaughnessy's research and long-term testing from his book, Millennial Money. There's the dual momentum approach, which is modeled after Deshaun Hang's academic study, Twin Momentum, Fundamental Trends Matter. More of a pure momentum model extracted from Wes Gray's book, Quantitative Momentum. And then there's a multi-factor or low volatility method developed by Pim Van Vliet and written about in his book, High Returns from Low Risk, and his follow-on research paper. So there's really two, I think, big points I wanted to mention here. One, I wanted to sort of get all these guru strategies on one page so you could see what is on Validea before we get into it. And then I guess the second thing is, all of these strategies have either been written about in books or academic papers. So the books obviously can be bought on Amazon. The academic papers can be referenced on SSRN. That's a website that houses academic research, and it's free to download those papers. So if any of these strategies, seem very interesting to you and you want to learn more, of course, you can use Validea to educate yourself on the strategies, but you can go directly to the sources, which is always probably the best thing if you really want to understand sort of what's going on with each of these models. Okay. Let me just make sure. I'll flip back here. Good. Okay. So, there's really two ways that this system can be used, and we're going to focus today on the individual stock analysis part of it. We're not going to go in the investment idea generation side. So what I mean by the individual stock analysis part is you can use these strategies once they're computerized, which is what we've done. You can use these strategies, which consist of fundamental criteria, and you can apply each one or multiple strategies to your individual stock research. So what's been done here is the most important investment criteria, whether it's fundamental criteria, valuation metrics, technical variables, these have been extracted and codified in each model that we run. And you can use them to determine the attractiveness of the stocks that you're interested in, the stocks in your portfolio, and to really get a sense of, is the stock sort of fundamentally sound based on the various model that you're looking at. And lastly, as you start to, I think, develop an understanding of these strategies, you might even be able to some extent, modify them and add in your own rules and thresholds to further sort of make a strategy more personalized and customized to you. You can't necessarily do that on Validea, but I can tell you that a lot of people use Validea and they might take a strategy and then incorporate other filters to further refine a list or to look at a stock through additional sort of lenses, if you will. These strategies can really be broken out into really what I'm going to call 4 or 5 different categories. We obviously run a lot of value strategies. So the Graham model, the Fisher-based approach, the strategy based on John Neff, David Dremin, Joseph Piotrowski, James O'Shaughnessy, Tobias Carlyle, and there's a private equity investor model based on a set of research out there. Those are what I would consider value-oriented strategies. So they're looking to find stocks that are cheap based on something, whether it's based on book value, based on an earnings multiple, based on cash flow, but they're trying to identify stocks that look cheap according to some sort of valuation metric. Then you have what I would consider sort of the value and quality category. This is where it's like the Warren Buffett based approach. So you're looking to buy high quality companies, but you don't want to just dismiss value. So our Buffett based model and the Joel Greenblatt model, which combines the value and quality component together, those two are what I would consider sort of in this value and quality camp. And then you have this other category that I'm calling quality and yield. So that is the Pim Van Vliet multi-factor or low vol model, Patrick O'Shaughnessy's model, and then Meb Faber that looks at shareholder yield. So those obviously have a very important yield component to them. Quality is also represented highly in those models. So investors that are attracted to dividend paying stocks, but also want quality, those are the strategies you'd want to focus in on. And then we have our growth at a reasonable price strategies. That would include the Peter Lynch model, the model based on the Motley Fool. O'Shaughnessy also has his cornerstone value and cornerstone growth strategy. So in this specific category, it would be the cornerstone growth methodology that he outlined. Partha Mohan Ram's model, and then the model that was developed by Wayne Thorpe, those would be considered growth and growth at a reasonable price. And then we move all the way to our more momentum type models that either are pure momentum in the case of quantitative momentum, which was developed by Wes Gray, or in the case of Deshaun Hang's twin momentum investor model and the momentum investor model we run based on the Cancelant methodology, those would incorporate and have a high degree of momentum or relative strength in them. So what I want to say here is that, if you know what type of investor you are, for example, if you're more of a value investor, then obviously the growth and momentum strategies, while you may find them interesting, you may not be utilizing them on Validea. So if you type in a ticker symbol and you see that the stock that you're interested in scores really low on the value strategies, but high on momentum, that should give you an indication, okay, well, this strategy isn't really, according to the models on Validea, a good value stock. And maybe I should be looking, for other securities that meet more value criteria. Or if yield's important to you, you probably want to stay away from the momentum strategy. So, finding the strategies and the models that align most closely with how you think about investing and what you believe in is very important. And all of these strategies, as we'll see in a minute, they're all different. They're all comprised of a different set of fundamental investment criteria. And so, one strategy might score a stock very high and another strategy might score it very low. But if the one that scores it very high is momentum and the one that scores it low is momentum or value, then that's what's happening there. That's kind of obvious, but I like to try to make sure I focus on trying to get people to find the models on Validea that best fit with how they are wired as an investor. Because if you can do that, you'll be more disciplined, I believe, and you'll be able to get more out of our investing system. Okay, so what I'm going to do now is I'm going to switch over to the actual Validea website, and let me just turn off my screen share, and I'll have to turn it back on. So just give me 1 second. So now I'm switching back over to the Validea site, and we're going to actually look at a couple stocks here using our Guru analysis engine. So all I am here is on the Validea homepage. I am logged in as a subscriber. A lot of what I'm going to show you here is behind the paywall, but it's not all behind the paywall. So for investors that aren't subscribers or that don't think they would ever subscribe, some of the research I'm going to show you is actually accessible to you. So it's not all just behind some paywall that you have to pay for. But the details and the nitty gritty are, because this is a subscription-based site, and this Guru analysis engine is a big, important component, a key feature of the website. So let's start looking at a couple of stocks here. I think I pulled 8 or 9 names, and what I wanted to do is just walk through each of these in a little detail. We won't go nuts with it, but just to demonstrate how our Guru analysis tool works. You can also get to Guru analysis, so you can go research Guru analysis, or when you're logged in on the homepage, you can enter the ticker symbol here. But let's come in this way. So Guru analysis. The first stock I wanted to show you was a stock that scores highly according to our our Warren Buffett based model, and this is Monster Beverage. So what I did is I typed in the ticker symbol Monster Beverage, and it brought me to this page, which is basically a summary page. So what you're seeing here is all the guru strategies on Validea and how the stock scores according to each of our models with a little strategy description. This page will always be available to you whether you're a subscriber or you're a non-subscriber. And this is really just giving you the score, and this is giving you sort of a quick snippet, if you will, of what goes into the strategy. It's not showing you any of the detail, but we'll look at that in a minute. But where this I think is valuable is if you come into this page for any stock you're interested in. So there's thousands of stocks that trade on the US exchanges, and thousands are analyzed through this system, and our data is updated daily. So as price sensitive variables change and as new fundamentals come in, as new IPOs come on the market, that data is fed to us, and then our system is, constantly crunching these numbers, crunching the scores to give you sort of the latest real-time score based on the latest fundamentals. So here I typed in the ticker symbol Monster Beverage. And I know, because I had looked at this before, that this stock passes the Warren Buffett based strategy with 100%. So when I click on this row, now what we're seeing is the details behind Monster Beverage and why it scores how it does. So let's look at this in some detail. The first thing we have is just a company profile here. A lot of the stocks, especially if you're using our screening application on the portfolios, a lot of the stocks that pop up you may not know about. So we put this here so people know what the heck the stock does. I think in this case, most people know that Monster Beverage is a energy drink maker, manufacturer. It actually has a deal with Coca-Cola. So it's kind of interesting that this stock scores very highly according to our Buffett model. And Buffett loves Coke. And Coke has actually often been rumored to wanting to buy Monster, although they haven't obviously pulled the trigger on that yet. But as we come down into the Buffett model, the first thing we want to see is, and hopefully I'm going to try to actually make my screen maybe one size bigger. So now we're getting into the detail. We're saying, okay, what criteria does the Buffett strategy look at? To start, it looks at 10 years of earnings predictability. So here it's saying how predictable have earnings been, how consistent have earnings been. And our system looks at the last 10 years of earnings. And as you can see, this is a nice upward movement, a nice steady increase in earnings per share. Monster has a long-term 10-year average EPS growth rate of 18.6%. That's very positive for this strategy because that earnings consistency and predictability is important to Buffett. We also know that Buffett doesn't like a lot of debt. So this model looks at, okay, can the company pay off its debt with the earnings that are being generated from the firm? Monster actually has no long-term debt, so that's extremely favorable. Then it looks at 10 years of return on equity and return on capital. This is how you get at, does the company have a competitive moat around the business? If a company can consistently deliver high return on equity and high return on capital, that means that something's protecting its business. It could be its brand name. It could be a low-cost producer. It could be a toll bridge company. The types of characteristics, whatever reason, there's something that's protecting the profitability that competitors haven't been able to erode away at yet. And so that's how this model does it. It looks at the 10 years of return on equity and return on capital. It then looks at capital expenditures. It wants to see free cash flow per share, looks at management's use of retained earnings, and then it wants to see, has the company been buying back stock as you come down here? So just before I go on, the important thing is any stock you look at, you're going to see how it passes each of these criteria, but obviously the variables, what's going to be stuffed in here is different because for each company, you obviously have a different set of fundamental criteria that are being produced by the company. As you come down into the model, it then basically says, I'm not going to go through all this because this is pretty detailed, but what it's trying to get at here, it's trying to say, okay, given the return, the earnings stream in the past, and given the return on equity, what is the expected rate of return I might be able to get from this stock over the long term going forward? Buffett typically likes to get stocks somewhere in the, let's say, 13 to 15% annualized return range, according to the model we extracted from Buffettology. So here, our two methods give us, one shows a 13.2% long-term expected return. The other shows a 23% long-term expected return. The average is 18.1%. So this expected return hurdle is passed, and Monster passes with 100% according to our Buffett model. Okay, let's look at another one. We're going to go deep value now. We'll kind of go into the beaten down retail space because I know that this is one that here's GII Apparel. They're behind sort of the Donna Karan, DKNY, and other, sort of brand name designer apparel, which obviously that's a business and industry that's kind of getting disrupted by probably a lot of things. But at least according to our Graham model, this stock looks very attractive. And this is mostly a deep value model. So this is the type of stock that's going to look favorable according to our Ben Graham strategy. So this is a lot simpler of a model. This was developed written about in The Intelligent Investor, which was, maybe 60 years ago. That book was published. So it first wants to see sales greater than 1 billion. The company has sales of 2.5 billion, so it passes that strategy. It then wants to see a current ratio of over 2. So that's current assets divided by current liabilities. That sort of indicates the financial soundness of the company. It then wants to see long-term debt in relation to net current assets. So basically, GI's long-term debt is 405 million, but its net current assets are 700 million. So that's a very positive for this. That's a hard criteria for a lot of companies to pass. So it passes that. It then just wants to see, okay, have earnings been growing? It doesn't have a very high earnings growth hurdle. I mean, a lot of deep value stocks actually don't have great earnings growth. But the fact is this company has been growing earnings over the last 10 years, albeit not great. It's still positive according to this model. And then the last criteria here is where you get sort of the last two criteria, you get sort of brings you further into this value camp. So it says, it wants only stocks with PEs of below 15. So in the case of this company, the PE is 10.4. It's probably about half the market PE at this point. And then also it wants the price to book times the PE ratio. It can't be greater than 22. So in this case, the company's price to book ratio is 0.56. The PE is 10.4, as we know. And when you multiply those things, you get below 22. So that's the Graham model. I think certainly for those investors that really are looking for beaten down cheap stocks, if you find that your stock passes the Graham strategy with 80, 90, or 100%, it's certainly got some value there. Okay, let's look at another one. We're going to look at the Peter Lynch model now. And we'll look at a couple more. I wanted to have this done in about 30 minutes. So I'll look at a few more and then we'll post a few things and then I'll take some questions if there's any questions. So here I'm looking at the Peter Lynch model. We're looking at the Johnson Outdoors, ticker symbol JOUT. So Johnson Outdoors is a outdoor recreation product manufacturer. They have a couple different segments of their business, but obviously with what's going on with the shutdown and COVID, a lot of these recreation companies are firing on all cylinders. And the Lynch model is really what I would call a growth at a reasonable price model. So the first thing that this model does that's interesting is it categorizes the stock or the company based on its growth rate. So you can either have a slow grower, a stalwart, or a fast grower. And depending on the earnings growth rate, you're going to look at, or the model looks at, a different set of fundamental criteria. So here it's considered a fast grower. And what the model does from there is it looks at the PEG ratio. So for investors that might not be familiar with the PEG is the PE over the growth rate. And the lower the PEG, the better. So in this case, the company has a PE of 20.5 and its average 3, 4, and 5-year historical growth rates are 45.8. So we're not just looking at the past year's growth rate. We're taking an average of the 3, 4, and 5-year historical growth rates. That's what Lynch advocated, sort of getting a longer term view of the company's growth rate over multiple time periods. So it passes that. Its PEG is 0.45, so that's very favorable. It then looks at the amount of sales, and it wants to basically see that the company has sales of less than $1 billion. And at least when Lynch wrote and published this model, the reason that was important was because once you get over $1 billion in sales, you start to get bigger. It's harder to generate that really high growth rate. So in this case, the company has sales of about $500 million. So at least according to the Lynch model, it looks at that favorably. It then looks at inventory to sales. It wants to see that inventories aren't increasing faster than sales. So it looks at the inventory to sales ratio. As I mentioned before, the EPS growth rate is important. Sort of the sweet spot for Lynch when trying to find companies that were growing and that could continue to grow was somewhere in this 20 to 50% earnings growth rate. He thought if you got over 50%, that was largely unsustainable. So the fact that, Johnson is coming in at 45.8, it's a little bit on the high end, but that is enough to pass this specific criteria. It then looks at the total debt to equity ratio, which is 0. So it doesn't look like the company has any long-term debt. Looks at free cash flow. It wants to see free cash flow. And these are bonus criteria. Then it looks at the net cash position. So here it looks at the net cash position of the share price. And it wants to see that, the company actually has cash on hand, which certainly I think is important in this environment. Okay, we're going to look at a couple more. We'll look at, what do we got here? We'll look at Allstate first. And then I want to show you. So here, and what I just entered Allstate, ticker symbol ALL, and it brought me into the Lynch strategy. When you want to switch strategies using the drop down here on the site, you can then jump to the strategy, or you can go back to the GRU analysis page, enter the ticker symbol, and you'll be brought back to the table. But when you enter the ticker symbol here, it's going to keep you on this detailed analysis page. So it keeps you sort of within the detailed GRU section. So here we're looking at the detailed analysis. This looks quite simple, but it's an interesting strategy. So this is developed by James O'Shaughnessy. It's called his VC2 or his value composite model. And what O'Shaughnessy is doing here is there's first a quality filter. So we have a way to percentile rank companies based on a number of quality criteria. So to start, we basically say, okay, let's make sure we're not in the stocks that are the lowest quality. So the first pass is companies need to be within, they can't be in the lowest 10th percentile. So anything above that is a pass. So in this case, Allstate's in the 46th percentile. Okay, good, positive, passes that criteria. Then what we do is we say, okay, let's look at the stock using a composite of the following value criteria: price to book ratio, price to sales, price to earnings, price to cash flow, enterprise value to EBITDA, and shareholder yield. It basically percentile ranks all stocks based on each of those variables, each of those value metrics, and then it calculates a combined rank, and stocks that are in the top 5% based on the combined ranking are the ones that get the highest score using this value composite strategy. So in this case, Allstate is in the 2nd percentile of the database. It's not the first, it's in the 2nd, but that's still pretty solid. So this is a good strategy for, again, it's a value strategy, but it gives you, I think, a chance to look at the stocks and analyze your stocks through a bunch of different value metrics. Obviously, we looked at Graham before. Graham was really looking at price to book and PE. Wasn't a cap in there. EV to EBITDA obviously wasn't in there. Shareholder wasn't in there. So price to sales wasn't in there. So, there's kind of some issues with price to book, and there's also some issues with price to earnings. But a composite sort of helps you get over some of the issues that each one of those valuation metrics have in isolation. So that's where the value composite strategy, I think, can be useful and interesting for investors that find themselves more value oriented. We're going to look at one more here, and then I'm going to do 2 more things, and I'll look to take some questions if we have any. I'm going to look at a company called, you guys might be familiar with this company, but it's Shutterstock. So anyone that has ever wanted to sort of purchase imagery and pictures online, Shutterstock is one of the leading companies that allows you to do that. So it's basically like a marketplace for, licensed media content that can be bought. And here we're looking at the strategy through the lens of the Partham Mohan Ram price to book to growth model. So what Mohan Ram tested and developed was, and anybody that's maybe listened to our podcast knows that we had Professor Mohan Ram on a few weeks ago where we talked about this. But what he developed was a model that looked to try to identify the growth stocks in the market that were likely to continue to perform well based on criteria that would indicate that they could continue to grow. As you may know, growth stock investing can be difficult because a lot of times growth stocks are expensive, and sort of collectively as a group, growth stocks really don't tend to perform that well. But there's some really good performers within the growth stock category. So how do you try to uncover those stocks with those characteristics? And that's really what this strategy is trying to do. So to start, the strategy actually looks for the most expensive stocks in the market using the book to market ratio, or the inverse of the price to book. So it starts out by saying, what are the 20% most expensive stocks in the market? From there, that 20% universe is analyzed through a number of different criteria. So it looks at return on assets. It wants to see return on assets higher than the industry average. It wants to see cash flow from operation higher than the industry average. It wants to see cash flow from operations to assets versus return on assets. It wants to see that higher. And then it looks at a bunch of other things like the variance in return on assets, the variance of sales. So in this case, it's rewarding sort of consistency more so. And then it looks at reinvestment in the business. Is the company spending on advertising? Is the company spending on capital expenditures? Is the company spending on R&D? Because those are the things that you want to look at when you want to say, okay, is this company likely to continue to grow? If the company's actually putting money back into the business and it's above its industry peers, then that's a good quality. That's a good thing to look for. Okay, so I went a little bit over. I'm going to see if there's any questions. And let's see, I can share, you guys that are still on, I'm going to share some files with you. Let's see if I can share multiple files. So I'm sharing some of the PDF. One of the things that we do on Validea is we do PDF reports where instead of having to jump from guru to guru, in Validea Pro, you can bring up our stock reports and you're going to get like a letter grade, and you're going to see the top 5 strategies sort of in a PDF report. So for an investor that wants to get sort of more of a, I guess, a view of in one document, the top strategies for the stocks they're interested in, those are in these PDF reports that I'm sharing with you. So you guys should be able to download those. I think those reports do a good way of demonstrating the models that we run. I am also going to send you guys a free copy because you've taken the time to be on this webinar. I'm going to send you a free copy of from the Guru Investor book, the Peter Lynch and Warren Buffett chapters. So if you want to read more about what goes into the Lynch strategy, what goes into the Buffett strategy, you'll be able to do that. And then the last thing I wanted to do just before I get to some questions here is I wanted to share this link with you. So I'm going to push this offer out in the webinar itself. Hopefully you guys can get it.